All right, let's just get right into it. Welcome to this exclusive Masterclass Explainer. Today, I'm actually putting on my lead examiner hat to take you straight inside the grading room. We are going to unpack things like the straight-line depreciation method, decode exactly what we examiners are desperately searching for in your answers, and ultimately build your A-star blueprint. Look, whether you are cramming for the upcoming exams or you really just want to understand the true mechanics of financial intelligence, you are absolutely in the right place. So let's get started.
I want to kick things off with a very direct, honest warning, right from our recent principal examiner reports. Listen to this closely. Students consistently lose vital marks through poor handwriting in ledger accounts and a failure to distinguish between revenue and capital items. Guys, it literally breaks my heart every single time I grade a paper and have to deduct points simply because I just can't read the numbers. Or even worse, because an unforced error was made misclassifying a super basic receipt. We are going to fix all of that today for sure.
Here is our highly structured agenda for today. We're going to cover the Examiner Core Vocabulary Guide, move into mastering T accounts, decode ratios, clarify those capital versus revenue roles, and finish up with the A-star exam strategy.
Okay, Section 1, Examiner Core Vocabulary Guide. Let's dive straight into the updated 2026 syllabus terminology.
What's really absolutely critical here is the shift in language. Using outdated terms will literally cost you points now. You must use irrecoverable debts instead of bad debts and owner's equity to maintain our fundamental accounting equation, which we all know is assets equals liabilities plus equity. Think about the business entity concept for a second. Imagine your business is a totally separate person sitting across the room from you. Owner's equity reflects exactly what that separate person, the business, owes back to you, the owner. This is not just wordplay, right? It's about aligning with modern international standards and proving to the examiner you know exactly what you're talking about.
Next up, we really have to talk about historical cost versus the prudence concept. The prudence concept dictates that potential losses absolutely must not be ignored. Why? Because ignoring potential losses is a direct violation of this principle. It dangerously overstates your business profits and, frankly, misleads your stakeholders. To put it simply, always anticipate your losses, but never anticipate your profits until they are actually realized in your hands.
So you must clearly distinguish between accrued and prepaid items, especially when applying the realization and consistency concepts to tricky scenarios. Let's use a clear example. An accrued item is an expense you owe but haven't paid yet, like an electricity bill for power you've already used. A prepaid item is an expense you've paid for in advance, like paying next year's insurance premium today. Getting these mixed up completely throws off your matching principle, and getting this right is exactly what separates an average paper from a brilliant A-star paper.
Section 2, Mastering T accounts and mechanics. Moving on to the actual mechanics of it all, let's look at how we visually structure our double entry system.
Now, this step-by-step procedural flow is your definitive roadmap to minimizing calculation errors when you're sweating under exam pressure. Step 1, you identify the source document, like an invoice or a credit note. Step 2, use your books of prime entry. Step 3, post to the T accounts. And Step 4, extract the trial balance. Following this exact sequence is incredibly crucial, especially when you are reconciling different business documents step by step or handling a massive volume of sales returns. It keeps your audit trails perfectly pristine.
Let's zero in on Step 3 for just a second, because this is a classic trap. So many students mix up the precise difference between balance brought down and balance carried down in their T accounts. Here's the deal. The balance carried down is the balancing figure at the end of the period to close the account. The balance brought down is that exact same figure moved to the completely opposite side to open the new period. Getting this backwards is an unforced error, and it's totally avoidable.
And that brings us to what I call the method mark paradigm. Look, as examiners, we aren't just looking for a correct final number. We are desperately looking for your accounting logic. Even if your final math is slightly off because you hit the wrong button on your calculator, showing your logical workings is an absolute treasure hunt for method marks. If we can see your logical flow in those T accounts, your correct method actually overrides the final mathematical error. So please, show your work.
Ultimately, your goal is 100% accuracy at the trial balance phase. That perfect balance proves your double entry records are rock solid, which is essential for external bank audits in the real world, and it ensures a seamless transition into creating your final financial statements. It's the whole shebang coming together perfectly.
Section 3, Ratios and True Business Health. Data entry is really just the baseline. Now we transition into high-level financial intelligence. Think about this.
If an exam question shows a current ratio dropping from 2.5 to 1 all the way down to 1.1 to 1, simply calculating that number is only the bare minimum. Honestly, anyone can punch numbers into a formula. But an A-star student? They tell me what that drop actually means for the survival of the business.
To secure that top grade, you have to evaluate the actual causes behind the drop. This reveals the true health and profitability trends of the business. Did the business overpurchase a bunch of inventory that is now just collecting dust in a warehouse? Are trade payables being settled way too slowly? Or did a massive capital expenditure completely wipe out their cash reserves? You have to ask these questions.
But remember, numbers don't exist in a vacuum, right? You absolutely must look beyond the surface data and analyze non-financial factors. Things like staff morale, business location, and market reputation wildly influence final accounting outcomes. A company with a slightly lower net profit margin but unbelievable brand strength and happy staff is almost always healthier than a highly profitable company with a toxic culture and high turnover.
Section 4. Capital versus revenue rules. Okay, let's tackle one of the most heavily tested and frankly, heavily failed areas on the whole exam.
We need to be crystal clear on this difference. Capital expenditure is buying a long-term asset, like a new delivery van. Revenue expenditure is the routine, day-to-day running cost, like putting gas in that van or paying for an oil change. The exact same logic applies to receipts. A capital receipt is the money you get from finally selling off that old van, while a revenue receipt is the everyday cash collected from delivering your goods to customers. Misclassifying an asset purchase as a routine office expense completely destroys your financial transparency. It artificially lowers your profit for the year and hides your true asset wealth. Keep this checklist in your head at all times.
And this leads us perfectly into depreciation. Interfirm comparisons are super tricky because different businesses adopt different accounting policies. The straight line method spreads the cost evenly, while the reducing balance method heavily front-loads the depreciation expense. This significantly changes yearly profit reports based purely on the method chosen. As an examiner, I want to see that you actually understand how these choices manipulate the final profit figure.
Section 5. The A-star exam strategy. Here at the examiner's desk, I'm going to give you my specific strategies for dominating the toughest parts of this exam. All right, let's go through some critical do's and don'ts. First, poor handwriting and terrible time management on those complex paper 2 questions are unforced errors you must avoid. Allocate your time strictly based on the question weightage. Second, clearly track your credit note issuance. If a business has a high volume of sales returns, tracking those credit notes properly is absolutely vital to maintain your net profit margins and audit trails. Think of a simple mental diagram. When a return happens, your revenue drops, but your liabilities or cash adjust perfectly to keep that accounting equation perfectly balanced. Visualize that.
Now, you want the ultimate A-star secret? Here is a classic trick question from recent past papers, confusing trade discounts with cash discounts. Remember this rule. Trade discounts are deducted immediately and never even appear in the double entry. Cash discounts do. Make sure you read the state symbols in manufacturing accounts carefully and never ever mix up how these two are recorded. When you are under the intense pressure of the exam clock, your mind can just blank out. It happens to everyone. To handle recurring calculation errors, use this incredibly simple heuristic mnemonic to easily recall your straight-line depreciation formula, CRL. Cost minus residual value divided by the useful life, CRL. Memorize it. Literally write it at the top of your scratch paper the second the exam begins so you don't make a silly calculation error later. And let's bring this all back into the real world. In 2025, modern AI tools and cloud accounting software like Xero automatically handle these depreciation adjustments, modern sales returns processing, and even complex bank reconciliations to seamlessly maintain the accounting equation. But remember, the software only works if the human programming the rules understands the foundational logic we've discussed today. The AI is doing the heavy math, but you are providing the critical intelligence.
So, I'm going to leave you with this final, provocative thought. Are your accounting records merely a mathematical exercise to you, or do they reveal the true, transparent financial intelligence of the business? Whether you are sitting for a massive exam or analyzing a real-world company, strive to make your records tell the true story. Thank you so much for joining me for this explainer, and I will see you in the next one.